Have you ever sat back after a long day at work and thought, there's got to be another way to make money, something that doesn't involve clocking in and out every single day? The constant hustle of the 9 to 5, early alarms, endless meetings, annoying coworkers, and that creeping anxiety about whether you're saving enough? I have been there too. What if I told you there's a way to get paid just for owning certain stocks and that, over time, those payments could grow so large? Welcome to the world of dividend stocks where your money works harder the longer you let it grow. You might think dividend investing is a modern concept, but it actually goes back over 400 years. In 1602, the Dutch East India Company started paying out profits to shareholders, which is the first real dividends. It was simple. If you own part of the company, you share in the success. Fast forward to the 1800s, and dividends became common in America, especially with railroads, banks, and utilities. These companies used dividends to show they were stable and profitable, and investors loved it. The golden age came after World War II. Big companies like Coca-Cola and Johnson & Johnson paid steady, growing dividends, and people even used them as income in retirement. But in the 80s and 90s, things shifted. Growth stocks, especially tech, took over. Dividends seemed boring compared to chasing fast gains. Then came the crashes of 2000 and 2008. Suddenly, the idea of getting paid while you invest looked pretty smart again. Now, even tech giants like Apple pay dividends, and more people are rediscovering the power of long-term compounding returns. In this video, I'll show you how steady, growing dividends can quietly build financial strength through the power of compounding. Dividend investing is a strategy where you invest in companies that pay dividends, that is, a portion of the profits they make is distributed to shareholders. When you own shares in a company that pays dividends, it's as if you're a part owner getting a share of the profits regularly. And by just holding on to your shares without doing extra work, you are able to profit from these companies. With careful strategy and reinvestment in dividends, those earnings begin to compound, growing steadily like that snowball gaining momentum. If you play it right, and soon enough, what started as something small could turn into something substantial, strong enough to change your financial future. So why are dividends really talked about a lot? They are valuable because they provide passive income without the need to actively trade shares for additional earnings, especially for young and new investors. They also offer stability because companies that regularly pay dividends tend to be financially strong. Even if stock prices fluctuate, dividends can still provide income which comes in cash or sometimes in additional stocks, which is usually paid quarterly. While it has its many benefits, I want us to also take a look at the trade-offs that come with those benefits. Although dividend may yield quarterly returns, those returns are sometimes not assured. Firms will cut or suspend payments when earnings fall or as economic conditions worsen. As an investor, it is essential to be well-informed and diversify your portfolio to control risk and maintain financial stability. Another benefit is the compounding nature of reinvesting payouts. It starts small, almost unimpressive, but if you're patient enough to reinvest your dividends, it sets off a quiet ripple effect. Every payout buys more shares, which earn their own dividends, fueling a cycle of steady growth. But genuine wealth doesn't get built in one night. It's cultivated. Years down the road, the compounding kicks in with maximum force, and what initially appeared to be a modest pursuit becomes something extraordinary overnight. In the long term, it's an accumulation that tends to increase gradually, untouched by market downturns because you've held on. What I am trying to say is that you need some discipline in investing and patience in holding on to your stocks to watch your money compound. Another reason why dividend stocks appeal to so many is that they do appear to be more stable. In tough markets, they can feel like a pillow. You're getting something back even when the market's down. But as a reality check, it is important to keep in mind that they're still stock and not always immune. Although there is some stability in dividend investing, you still need to manage risk wisely and not get too comfortable. Another benefit people see as a plus to dividends investing is that it has some tax advantage. Qualified dividends in some areas are taxed at a lower rate than regular income, and that is a pleasant added bonus for a long-term investor. But that is very much based on where you live. Not all countries treat dividends the same, And even within a country, not all dividends qualify for that lower rate. And if you're holding these investments in a retirement account or something tax-sheltered, the tax perks might not matter all that much anyway. Lastly, there's the idea that dividends can help protect against inflation. It all adds up if a company increases its dividend payments year after year, allowing your income go up along with inflation. But this is not automatic either. Not all companies increase their dividends on a regular basis, and in times of high inflation, even those increases might not keep pace. Even worse, some businesses try too hard to keep raising dividends just to wow investors, even if it is not financially prudent for them, which might hurt you and them in the long run. So yes, investing in dividends does have some clear pluses. It can be a good way to build wealth, reduce your reliance on active earnings, and have more fiscal elbow room. But like any approach, it works best for you when you understand the upside and downside. Let's take a real-world look at how everyday people are building steady income streams with dividend stocks, sometimes without even realizing how powerful it can be. Take Alex, for example. He's an investor with a smart, long-term mindset, looking to grow his wealth without constantly buying and selling stocks. After doing his research, he discovers Coca-Cola with ticker symbol KO has been paying dividends for over a century, and not only that, but they've consistently increased those payouts over time. That kind of stability sounds good to Alex. So, in his first scenario, he decides to buy 100 shares of Coca-Cola at $60 each, investing $6,000 total. Since Coca-Cola pays an annual dividend of $1.84 per share, that means Alex pockets $184 in dividends every year, split into quarterly payouts of $46. But here's where things get interesting. Instead of spending that money, Alex reinvests his dividends to buy more shares. With Coca-Cola's price holding around $60, he can buy roughly 0.77 extra shares each year, gradually increasing his total holdings. Over time, this compounding effect kicks in, his number of shares grows, his dividend payouts increase, and his wealth builds automatically. What started as a simple investment in a well-known everyday brand quietly turns into a powerful source of passive income, proving that sometimes even the most boring investments can be the most rewarding in the long run. Finally, let's take a closer look at how dividend compounding can be a game changer for long-term wealth. The idea is simple. It is reinvesting dividends over time instead of spending them, allowing your portfolio to grow and creating a powerful snowball effect. Imagine you started investing in Coca-Cola in 2013 with $5,000. At that time, the stock was priced at $41.31 per share, meaning you were able to purchase about 121 shares. Fast forward to the end of 2014, Coca-Cola pays an annual dividend of $1.22 per share, giving you $147.66 in passive income. Instead of cashing it out, you reinvested it, buying additional shares, bringing your total holdings to 124.5 shares. This process continues year after year. Each dividend payment buys more shares, which in turn generate even higher dividends. By 2024, your initial investment would have doubled to approximately $10,500, thanks largely to compounding rather than just stock price growth. And if you keep reinvesting for 20 years, your returns could skyrocket to 400 to 500%, all from choosing a company with reliable, steadily increasing dividends. Unlike high-growth tech stocks that can shoot up unpredictably, Coca-Cola's value has climbed at a steady pace, consistently rewarding shareholders with dividends. This long-term, patient approach proves that investing doesn't have to be flashy to be effective. Dividend compounding can be a slow and steady path to financial security, and it works best when you choose companies with a solid track record. Over time, reinvested dividends quietly work behind the scenes, turning small investments into significant wealth. I hope this helped paint a clear picture of how powerful compounding can be. Do not hesitate to ask questions, comment, share, and like this video. Let us know what you would like to see next. Until next time, go make your financial dream a reality.